So in the context of portfolio language, a financial planner's language, an investment manager's language, an estate planner's language, a CPA's language, they use their language. In the context of portfolio language, what type of lifetime use life insurance would be in my best interest? And our process is to say, let's use some financial planning and investment planning terminology and concepts. So what do you think? You've got a conservative, self-declared conservative investor. She does not like to take a lot of risk. She sits down with an insurance advisor, and the insurance advisor says, have I got the deal for you? I can get you a really cheap policy, and the real bonus here is you get to invest the premium in mutual fund-like sub-accounts. What do you think is her impression if she takes the time to get beyond really cheap premium, which is what she's drawn to? What do you think is the disconnect there? She's a conservative investor. Did I just talk about a policy that's going to appeal to her? No. So what we're doing is we're suggesting that between the two basic platforms of insurance design, guaranteed pricing and projection pricing, that we map the client's self-declared risk tolerance to a suggested style of policy that you might start with. So a conservative should be looking at participating whole life. And we would define the risk as intolerant of volatility and seeking guarantees. And we would then look at what are the underlying risks, if any, that you need to know about so that you can confirm that in this case there isn't much volatility and you certainly have guarantees. Underlying investments in U.S. and high-grade corporate bonds, premiums guaranteed, policy guaranteed, upside potential, and the dividends, of course, not guaranteed until declared. Now there is another kind of product that would fit this self-declared style of conservative, which is the no-lapse guarantee, but there's different issues about such a policy. Death benefit and premium obligation are guaranteed. Better buy it from a company who's going to be around. Bare bones, what you see is what you get. No upside for death benefit, and lifetime term insurance is a good way to think about this. You've got no lapse guarantee. No lapse guarantee fits in certain situations. No way does it fit all the situations for which it was sold to replace virtually anything under the sun over the last 10 years. You now get the opportunity in talking to advisors of speaking the truth with authority. You have to have both, speaking the truth with authority. And we hope that we're transferring that authority to you through these white papers. Very quickly then, if you had someone whose investment style is balanced, we might suggest that you'd start with a traditional universal life, which is defined as tolerant of modest volatility, willing to accept fewer guarantees in favor of premium payment flexibility. The problem with universal life, the first policy was sold in 1977, so it's been around for 34 years, is there are still agents, therefore there are still a lot of clients that do not understand that the illustration is not the policy, the premium is not the premium, and that the risk. Why do you buy life insurance? You buy it to transfer risk. I mean, any kind of insurance. You transfer risk. That in buying a universal life, you took back enormous risk. What is that risk?
Interest rate, mortality.
That's not the risk.
Failure, policy failure.
Policy failure. That's all that anybody cares about. Is this policy going to be around? Is the insurance company going to be around 30 days longer than I am? And will the policy be around? You only need 30 days. So universal life has its place, and I'm going to talk about that a little later. Universal life has its place. No lapse guarantee has its place. Unfortunately, they get blasted at the prospect or at the advisors who are trying to get in with the lowest price or whatever it is, rather than very thoughtfully, skillfully, professionally saying, well, let's talk about your or your client's risk tolerance. Tell me a little bit about her. How does she tend to invest her money? Because that would help inform us as the kind of insurance we should perhaps start talking about. That's a completely different conversation. And the ears perk up on the advisors and even the clients. Well, I haven't heard this before. Growth to aggressive growth, variable universal life. How many of you have sold a variable universal life in your careers? Okay, that's a little bit more than in most Guardian groups. Variable too has its place. First of all, you better have a growth to aggressive growth risk tolerance, or it doesn't make sense. And you have to understand that that risk has been shifted, the sufficiency risk has been shifted, and the illustration, at least among here, I'm going to say, the illustration lies. Variable universal life illustrations lie, because there's no way that the assumptions of the illustration match reality, or I should say there's no way that reality matches the assumptions of the illustrations. So are they lying intentionally? No, I don't think so. But a variable universal life illustration is very misleading, and you have to better understand what's really going on. And so you really have to have risk tolerance for that to make any kind of sense. A style that I call conservatively aggressive, which is the best I could come up with to describe equity index universal life, which I then go on to say intolerant of volatility, yet desiring the attractive impossibility of the downside without understanding the dynamics of indeterminate pricing. And if anybody can parse that out, they're more than welcome to the product. So one of the things I will tell you, I am an independent insurance fiduciary. I do not sell for commission. I get paid a fee for what I do. I am completely agnostic as to what product the client should buy when they come in as a blank slate. As I get to work with them, I have a much better understanding of what products make sense for them. I will tell you, I have yet to find anyone for which this product makes any sense. Enough said. So I get asked a lot, so what's the best kind of life insurance? Now the obvious answer is par whole life. But what I just ran through suggests that if you leap to that too soon, you lose your credibility. I think par whole life fits in a lot of situations, far many more situations than the no lapse guarantee, and certainly more than the equity index universal life. But yet I want to urge you to hold back that compulsion to leap with a par whole life and let the case develop.